The greatest market movements, the ones that create legendary fortunes, are almost never born from a single dramatic news event. They do not appear suddenly out of the chaos of the daily tape. Instead, they are the result of a long, slow, and often invisible period of preparation. William Delbert Gann, in his scientific study of the markets, taught that every great effect must have an equally great cause. He used the analogy of constructing a great building. The larger the building, the more time required to construct the foundation. It is the same with stocks. The greater the advance or the decline, the more time required in preparing for it. The history of the stock market is filled with examples of this principle, but perhaps none is more perfect, more complete, or more instructive than the story of the Corn Products Refining Company. It is the ultimate case study in the methodology of William Delbert Gann, a living chart that demonstrates how nearly a decade of profound public apathy and quiet professional accumulation laid the foundation for one of the most explosive bull markets of its time. This is the story of how a stock trading at $8 a share, a company left for dead by the investment community, was reborn to advance over 1,500% to a final peak of $134. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. Our story begins in the year 1906. The market was in the midst of a powerful bull campaign, one that had been underway since the bottom of the rich man's panic in 1903. Confidence was high, business was expanding, and speculation was rampant. In this environment, Corn Products Refining Company was an established industrial concern, a significant player in its field. As a leader of its time, it participated fully in the bull market, and in that year, it reached a major high of $28 per share. To the analyst following the methods of William Delbert Gann, this price level would have been immediately recorded and marked as a point of significant historical importance. It was the peak of that bull market cycle for the stock, the level at which the buying power of that campaign was finally exhausted, and the selling pressure of the informed operators, the insiders, became great enough to halt the advance. This price of $28 was not just a number, it was the establishment of a great wall of resistance, a ceiling that would overhang the stock for more than a decade to come. What followed this 1906 peak was a period of distribution, where the stock moved sideways, unable to advance further, as the insiders who had bought at lower levels began to methodically feed their shares into the hands of an optimistic public. Then, the character of the entire market began to change. The great forces that had propelled the bull market for years began to wane. In 1907, the tide turned. A silent panic began, a credit crisis that shook the financial world to its core. As confidence evaporated, selling pressure mounted, and the market entered a severe decline. Corn Products, having been thoroughly distributed at its highs, was now in the hands of weaker, less informed holders. It had no strong underlying support, and it collapsed along with the rest of the market. The decline was swift and brutal. From its peak of 28, the stock plunged relentlessly downward, finally reaching an extreme low of just $8 per share in the panic of 1907. This was a catastrophic decline of over 70%. At this point, the stock was, in the eyes of the public, a ruined enterprise, a testament to the dangers of Wall Street. This price of $8, born of fear and capitulation, now became the second great architectural point on our map. The peak at 28 was the ceiling. The panic bottom at 8 was the floor. The battlefield for the next decade had been defined. Following the Great Panic of 1907, Corn Products entered what can only be described as a long and desolate journey through the financial desert. For the next 10 years, it was a dead stock. It was the very definition of a laggard, an outcast, a profound and continuous disappointment to any hopeful investor who purchased it. This is the period that William Delbert Gann would have identified as the Great Accumulation phase, the long, slow, and boring process of building the foundation for the next great bull market. To understand the psychology of this phase, One must place oneself in the mind of the average trader of that era. After the trauma of the 1907 crash, any rally was viewed with suspicion. The public had been taught a painful lesson, and their primary emotion was no longer greed, but a lingering fear. The stock did stage a recovery rally along with the general market into 1909, a move that carried it back up to $26 per share. Here, the first great test occurred. It had rallied to within 2 points of its historic 1906 high of 28, and at this level, it met a wall of selling. The supply of stock from those who were still trapped from the previous bull market, eager to get out at break-even, was too great. The rally failed, and the stock turned down once again. This failure to surpass the old high was a clear sign that the stock was not yet ready for a new bull market, and that the process of preparation was far from complete. What followed was another punishing decline. From the failed rally high of 26, the stock fell back relentlessly, declining to $10 in 1911, and then, in the weaker market of 1912 and 1913, it made the long, painful journey all the way back down to its panic-era low of $8. This event, which occurred in 1913, would have been of immense significance to a Gann analyst. The stock had now formed a massive double bottom over a 6-year period. This was the market's own testimony that at the $8 level there existed a powerful and patient buying interest, an invisible support, willing and able to absorb all the shares that the discouraged public could throw at it. This was not a guess. It was a recorded fact on the chart. The sellers had been given 6 years to break the stock below its panic low, and they had failed. This was the first great structural sign that the absolute bottom was in, and that a major long-term accumulation campaign was underway. Even after this powerful confirmation, the stock did not immediately begin its great advance. The process of accumulation is a slow and methodical one. For the next 3 years, from 1914 through 1916, corn products drifted lifelessly, trading for the most part in a narrow range between $10 and $20. This was the heart of the boring period. These were the years when the final weak holders, exhausted by a decade of disappointment and seeing other war baby stocks begin to make exciting moves, finally gave up in disgust and sold their shares for a small profit or a manageable loss. This is a critical psychological point. The market often gives these small, frustrating rallies within a great bottoming formation to encourage the last of the weak hands to sell out. The amateur, impatient for action, sells his shares to the professional, who is patient and understands the great cause that is being built. During this time, as William Delbert Gann described it, the stock became very inactive and the volume of sales was very small, a clear indication that the selling pressure, the motive power for the decline, had been completely exhausted. The stock was now almost entirely in the hands of the strong, informed operators who had been patiently absorbing it for a decade. The foundation was complete. The spring was fully coiled. The stage was set for one of the great bull markets of the early 20th century. After a decade spent wandering in the financial desert, a period defined by public apathy and professional patience, the character of corn products began to undergo a profound and decisive transformation. The 10 years of quiet, methodical accumulation had served their purpose. The vast majority of the company's shares, once held by a hopeful and then a despairing public, had now been fully transferred into the strong, unwavering hands of informed interests. The floating supply of stock available for sale had been drastically reduced. The great foundation, as William Delbert Gann would describe it, had been laid. The market was now perfectly prepared for the second act of this great drama. The signal that the long winter was over and a new, powerful bull market was at hand. This is the story of that signal, the moment of transition, and the professional strategy required to act upon it with confidence and precision. The turning point, the single event that transformed corn products from a dead stock into a dynamic growth leader, occurred in the year 1917, after a decade of being trapped below the formidable resistance of its 1906 high. The buying power that had been quietly accumulating for years finally swelled into a dominant, undeniable force. The price began to advance with a new and vigorous energy, an energy not seen since its last bull market. It moved up through the teens, through the low 20s, and then it arrived at the great historical battleground, the old 1906 high of $28 per share. To the professional analyst following the rules of William Delbert Gann, this was the moment of truth. The action at this level would determine the stock's fate for years to come. He taught as a primary and unbreakable law the immense significance of crossing major old levels. In his masterwork, Truth of the Stock Tape, he dedicated an entire chapter to this principle, stating, "When stocks establish certain levels of accumulation or distribution over a long number of months or years, and then cross them, it is almost a sure sign that they are going to new high or low levels." An old high is not just a number on a chart. It is a psychological barrier, a wall built from the collective memory of past failure. It is the price at which countless traders were trapped, where hopes were dashed, and where a massive supply of stock is waiting to be sold by those who long to get out at break-even. For a stock to break through such a formidable decade-old barrier, the demand must be exceptionally powerful and aggressive. It must be strong enough to absorb every last share offered for sale by the old, weary holders. A breakout above such a level is therefore not a minor event. It is a tectonic shift in the balance of power. It is the market's own declaration that the long period of preparation is over and that a new, powerful markup phase has begun. This is precisely what happened with corn products in 1917. The stock did not just touch the $28 level. It pushed through it with force and conviction. William Delbert Gann, in his detailed analysis of this very event, wrote, "In 1916 it advanced to 29, which was the highest price of its history up to that time, and 1 point higher than the level of 1906. The stock being in new territory, and higher than it had sold for 10 years, showed that accumulation had been completed and that a big advance was likely. This was the definite, unambiguous signal. It was the moment the coiled spring, having been compressed for 10 long years, was finally released. The decade of boredom was over. The great bull market in corn products had officially begun. This was not a moment for hesitation or doubt. It was the moment for decisive professional action. For the trader who had been patiently watching this 10-year drama unfold, the breakout above 28 was the signal he had been waiting for. This is where the professional's strategy diverges completely from that of the amateur. The amateur, having missed the entire accumulation phase, would likely see the stock at a new 10-year high and declare it too expensive to buy. The professional, however, understands that this is precisely the safest and most logical time to enter. He is not buying at a high price. He is buying at the beginning of a new trend, a trend that has just been confirmed by a decade of preparatory work. The first strategic action for the Gann trader would be to buy on the breakout. Following his own rule number 9, never limit your orders or fix a buying or selling price. Trade at the market, he would not quibble over an eighth or a quarter of a point. When the stock showed decisive strength above the $28 level, he would have entered the market, knowing that the cost of missing the start of a major move far outweighs the cost of paying a slightly higher price. His entry is not a guess. It is an action based on a clear mechanical signal, the violation of a major multi-year resistance level. The very next action, taken at the same moment as the entry, would be to place a protective stop-loss order. This is the non-negotiable act of a professional. The stop would be placed at a logical point below the breakout level, perhaps at $25 or $24, just below the zone of recent consolidation. This stop-loss is not a sign of fear. It is a sign of intelligent business practice. It is the trader's admission that while the breakout is a high-probability signal, it is not an infallible one. The stop-loss mathematically defines his maximum risk and ensures that a single mistake can never lead to a catastrophic loss. With the initial position established and protected, the professional trader would then engage in a second act of patience. He would not immediately chase the stock higher. Instead, he would wait for the first normal correction, or what is often called a throwback to the old resistance level. It is a common and healthy market behavior for a stock, after breaking through a major resistance, to pull back and test that same level from above. That old ceiling has now become a new floor. The trader who missed the initial breakout, or the trader looking to add to his position, would watch this pullback with intense focus. If the stock returned to the $28 level and found support, if it held that level on lighter volume and then began to turn up again, this would be the second and often safest point of entry. It is the market's final confirmation that the old resistance has indeed become the new support. At this point, the trader could confidently add to his position or pyramid, knowing that he is operating in perfect harmony with the newly established primary uptrend. To apply these strategic rules with a master's precision, you must learn to grasp the dynamics behind every price movement. William Delbert Gann's Truth of the Stock tape is the foundational guide for this skill. It's not a book of theory. It's a practical course that teaches the reader to understand the real-time contest between buyers and sellers, recognize the critical phases of accumulation and distribution, and assess a trend's true strength. This edition is a faithful reproduction of the 1923 original. The historical charts from that 100-year-old publication are included. While many are difficult to read, their inclusion was deemed important for historical context. The true timeless value, however, lies in Gann's text. For any serious student ready to understand the market's real intent, this book is an essential resource. Get your copy via the link in this video's description. After a decade of quiet preparation, the great cause for a major bull market in corn products had been built. The breakout above the historic 1906 high of $28 was the definitive signal that the long winter was over. This was the turning point, the moment the stock was reborn from a forgotten laggard into a dynamic new leader. The professional trader, following the scientific methods of William Delbert Gann, would have established his position on this confirmation of strength. Now, the second and most profitable phase of the operation was set to begin, the great markup, or what William Delbert Gann would call the effect. This is the story of that effect, a multi-year bull market that serves as a masterclass in the character of a healthy trend, the nature of its corrections, and the final telltale signs of its ultimate culmination. The heart of the bull market, the long and sustained advance, began in earnest following the breakout. As William Delbert Gann noted in his analysis, then the 1919 bull campaign started and corn products began to advance. It continued to make higher tops and higher bottoms, showing that demand was greater than supply, advancing to 99 in 1919 and in the spring of 1920 to 105. This simple description contains the very essence of a healthy uptrend. The consistent pattern of higher tops and higher bottoms is the mechanical definition of a bull market. Each new high demonstrated the power of the buyers, and each reaction that held above the previous low proved that the sellers were weak and that demand was re-emerging at progressively higher levels. During this phase, the character of the stock was one of quiet strength. The wild, dramatic swings were still in the future. This was the first zone above normal, a period of a quiet advance that attracts little public attention. The professional trader who had bought on the breakout would now be practicing the discipline of patience, his strategy dictated by rule number 10. Don't close your trades without a good reason. The only good reason to exit a trade in a confirmed bull market is a definite mechanical signal that the primary trend has changed. As long as the stock continued to make higher tops and higher bottoms on the weekly and monthly charts, the professional's job was simply to hold his position, protected by a trailing stop-loss, and let his profits run. The shallow and orderly nature of the corrections during this period was, in itself, a powerful sign of the trend's health. It showed that the selling was not aggressive, but was merely the light profit-taking of weaker hands, which was easily absorbed by the dominant, underlying demand. After reaching a peak of $105 in the spring of 1920, the stock entered its first and only major corrective phase of the entire bull market. This occurred in alignment with the general market, which experienced a sharp post-war bear market into 1921. Corn products, which had been so strong, was not immune to this selling pressure. It began a decline that would last for over a year, a period that would test the nerve of any trader. The stock fell from its high of $105, declining to $61 in December of 1920. After a rally to $76 in March of 1921, it made its final corrective low at $59 in June 1921. This point, at $59, was the final great buying opportunity before the most spectacular phase of the advance began. To the amateur, a decline of nearly 50% from the high would have been terrifying, a sure sign that the bull market was over. But to the professional analyst following the rules of William Delbert Gann, the action was profoundly bullish. The most important fact was not how far the stock had fallen from its recent high, but how far it remained above its foundational base. The final low at $59 was more than double the breakout price of $28. This was an immense sign of underlying strength. It demonstrated that the character of the stock had been fundamentally and permanently altered. The old ceiling at $28 had become a new unbreakable floor, and the market had no interest in even retesting it. As William Delbert Gann noted, the stock was now in a strong bull position and should be bought with a stop under this low level. This final, major correction served to shake out the last of the nervous holders and to allow the original insiders to add to their core positions. With this last test complete, the stage was set for the final and most explosive act. From the June 1921 low of $59, corn products began its final climactic advance. This was the phase where the stock moved into the second and third zones above normal. The advance became more energetic, the public became interested, and the stock began to attract widespread attention. The quiet accumulation was over. The public markup was in full swing. The advance was relentless. The stock pushed through its old 1920 high of $105 with ease, a sign of immense power, and continued to surge upward. This was the time for the professional who had held through the correction or added to his position at the $59 low to enjoy the greatest rewards of his patience. The stock was now in a full-blown speculative fever. This final, powerful wave of buying carried the stock to its ultimate peak of $134 during the week of October 21st, 1922. At this level, after an advance of more than 1,500% from its foundational lows, the character of the stock began to change once again. The effortless upward momentum ceased. The stock had entered the third zone, the zone of distribution. William Delbert Gann described the price action at this final top with clinical precision. After that, it reacted to around 124, then rallied 5 or 6 times up to around 132 to 133, but failed to make the high price of October 21st. It remained in this trading range between 134 and 124. This shows that it has reached the level where it is meeting with great resistance and heavy selling. This was the final signal. The repeated failure to make a new high despite the high volume and wide fluctuations was the market's own testimony that the supply was now equal to or greater than the demand. The great bull campaign was over. The strategy, as William Delbert Gann stated, was now clear. The proper thing to do is to be out of long stock and short. The multi-decade story of corn products is the perfect living embodiment of the core principles of William Delbert Gann. It is a masterclass in his scientific and methodical approach to the markets. The colossal 1,500% advance was not an accident, a bubble, or a stroke of luck. It was the logical and inevitable effect that grew out of a massive and sufficient cause. The cause was the 10-year period of quiet, patient accumulation. The long, boring decade when the stock was methodically passed from the weak, discouraged hands of the public into the strong, informed hands of the professional operators. The breakout above the decade-old high in 1917 was the definite signal that this great cause had been completed. The subsequent multi-year bull market was simply the natural and proportionate result. This single case study proves the profound power of the Gann methodology. It proves the immense rewards of patience, the discipline to watch a stock for years while it builds its foundation. It proves the critical importance of studying market history on long-term charts, for it was only by knowing the location of the 1906 high that a trader could have recognized the significance of the 1917 breakout. And above all, it proves the supreme profitability of trading on definite mechanical signals rather than on the treacherous emotions of hope and fear. It is by understanding and applying these principles that a trader can learn to identify the great opportunities of his own time and, in doing so, transform speculation into a profitable profession.